Hi, I am Vijendra. Welcome to DebtCircle Key Roundups coming to you on May 5th, 2026. Foreign investors are favoring short-term Indian government bonds, with over two-thirds of top purchases maturing in less than 5 years from March to May, up from less than half earlier this year. This shift aligns with expectations of a tightening monetary policy by the Reserve Bank of India. The front end of the yield curve now offers better risk-adjusted returns with lower duration risk, making short-term bonds more attractive. Despite a likely rate pause in June, tightening is anticipated, which keeps long-term yields vulnerable to further increases.
That makes sense. The 5-year bond yield rose by 55 basis points from March to May, while the 10-year yield increased by 34 basis points, narrowing the spread to 15 basis points, an 8-month low. This bear flattening signals investors expect short-term rates to rise more sharply. And with the exchange rate at about $1 to 95.78 rupees, foreign investors find the Indian debt market compelling, especially amid inflationary pressures linked to the Iran conflict and energy shocks.
Moving to our next story, the Indian rupee opened stronger at 95.7125 against the US dollar, climbing to 95.6475 ahead of the Reserve Bank of India's policy announcement. This rise occurred despite weak Asian markets, driven mainly by flow adjustments. Economists expect the Reserve Bank of India to maintain current interest rates, citing excess capacity, a current account deficit below 1% of GDP, and core inflation under 4% for over 2 years. Raising rates sharply to defend the rupee could hurt growth.
That's notable, Vijendra. Regional currencies mostly weakened due to Middle East tensions and stalled negotiations between the United States and Iran. The rupee's modest gain shows investors are focused on the Reserve Bank's upcoming policy decision as the main influence on currency direction. With global financial tightening from the West Asia crisis, the Reserve Bank faces a tough balance, attracting capital inflows without stifling economic growth, making this policy announcement critical for market sentiment.
Here's another significant update. India's money market turnover hit a record 5.5 trillion rupees on May 13th, driven by state-owned banks borrowing heavily to meet strong credit demand in sectors like power and data centers. Right. Bank lending grew at 16.2% annually, outpacing deposit growth for 8 months, widening the credit-deposit gap to 400 basis points, increasing pressure on banks' funding costs.
That surge reflects robust economic growth despite global disruptions, but it's pushing overnight borrowing costs up as banks struggle to attract deposits amid shifting household savings. Meanwhile, private banks turned net lenders in May, selling rate-sensitive assets to brace for possible rate hikes, adding complexity to India's money market dynamics and monetary policy expectations.
Let's move on to our next article. Gross premiums underwritten by insurance offices registered with the International Financial Services Centers Authority in Gift City jumped to $648.7 million in financial year 25-26, a fourfold increase from $162.1 million the previous year. The number of insurance entities doubled to 36 by March 26, including 14 direct insurers and 22 reinsurers, fueling the premium base's consistent rise from 84 million in 22-23 to over 1.2 billion in 25.
That growth mainly came from reinsurance, which surged to 607.9 million, while direct insurance premiums also rose to 40.7 million. This shows expanding market confidence within Gift City's financial ecosystem. Quarterly figures confirm this trend, with reinsurance premiums hitting 187 million in the last quarter of 25-26, underscoring robust sector growth despite some short-term volatility.
Here's another significant update. Recent turbulence in the US and Europe has exposed liquidity risks in private credit, with redemption restrictions and rising payment-in-kind income signaling stress. Yet, according to Preqin's November 2025 survey, 91% of limited partners say private credit still meets or exceeds expectations. India's private credit yields range from 14 to 22%, significantly higher than bank loans at 8 to 10%. The Shapoorji Pallonji Group's $3.1 billion deal shows India's emerging institutional-grade structuring.
That highlights a market recalibration rather than collapse. Meanwhile, India's private credit market, valued at 25 to 30 billion dollars, grew 35% in calendar year 2025, driven by domestic funds and sectors like real estate and healthcare. Regulatory support is strong too, with nearly 1,800 registered alternative investment funds as of February 2026, and commitments hitting rupees 15.74 trillion by December 2025, expanding India's private credit ecosystem.
Moving to our next story. TrustPaisa now uses a fully autonomous artificial intelligence system to process loan applications instantly, completing approvals within seconds without manual checks. This leverages partner-approved credit policies and regulatory rules to make real-time decisions efficiently. Removing manual verification cuts operational costs and boosts efficiency, vital in a low-margin, high-volume lending market. The artificial intelligence system strictly follows partner guidelines, with regulated lenders maintaining full lending responsibilities.
This shift reflects a key market trend in India where faster digital loan approvals are essential. It helps TrustPesa manage high application volumes and after-hours requests better, while human roles focus on quality control and policy oversight. The automation also demands stronger governance, continuous model testing, and audit trails to ensure compliance and consistent outcomes. TrustPesa plans to extend artificial intelligence use to onboarding and collections, aiming for end-to-end digital credit processes.
Let's look at another key development. SEBI issued a warning to ICICI Bank for allowing an FPI to repatriate funds prematurely under the voluntary retention route, violating the committed retention period. The bank received this letter on June 2nd and immediately informed stock exchanges. Financially, ICICI Bank reported a net profit of Rs 13,701.7 crores, an increase of 8.5% year-on-year, surpassing market expectations. Asset quality also improved, with net non-performing assets dropping to 0.33%.
This regulatory hiccup is notable, but the market seems unfazed. ICICI Bank's shares rose by 0.80%, closing at Rs 1,252.30, reflecting confidence despite the warning. Reduced provisions from 2,556 crores to 96.2 crores signal stronger credit health. Overall, the bank's operational metrics remain robust despite the compliance issue.
Let's move on to our next article. The Reserve Bank of India kept the key policy rate unchanged, maintaining a neutral stance. They raised the inflation forecast to 5.1% and lowered GDP growth to 6.6% for the current financial year. Importantly, the RBI exempted foreign institutional investors from capital gains tax on government securities interest, aiming to boost foreign inflows and support the rupee.
That pause in rates benefits financials and state-owned banks, which gained over 1%. It also reassures markets by balancing inflation concerns with growth stability. This tax exemption should lower bond yields and improve investor sentiment, helping to ease pressure from rising crude prices and capital outflows.
Let's move on to our next article. Power Grid Corporation will hold a board meeting on June 10, 2026 to consider raising funds through an unsecured term loan. This aims to strengthen their financial resources for operations. The company has informed the National Stock Exchange of India Limited and Bombay Stock Exchange Limited, where their securities are listed under Power Grid and 532898 respectively.
The market impact includes a trading window closure from June 5th to June 12th, 2026, preventing insider trading. This ensures compliance and maintains market integrity around the decision. Investors and debt market professionals should watch for updates post-meeting, as the unsecured term loan could affect Power Grid's capital structure and financial stability.
Moving to our next story. Aditya Birla Housing Finance raised 9.60 billion rupees through bonds split into 3-year and 5-year maturities. The coupons are 8.22% and 8.25% respectively, with a AAA rating from CRISIL. The issue was divided into 5 billion rupees for the 3-year and 4.60 billion rupees for the 5-year bonds, both issued on the same day, June 4th, ensuring diversification in tenure for investors.
The strong AAA rating makes these bonds attractive for investors seeking medium-term options. With fully accepted bids, it shows confidence in the housing finance sector and adds quality debt instruments above 8% coupons to the market. This issuance reflects healthy demand for high-rated paper with stable returns, supporting liquidity and providing investors with secure choices amid current market conditions.
Moving to our next story. Several senior banking executives have resigned recently from leadership roles in Gujarat International Finance Tech City, including heads from Singapore's DBS Bank and Standard Chartered. This signals rising competition for experienced financial professionals amid the hub's growth. Even Mashreq Bank's head left after just 1 year, showing instability. Despite business growth and inflows from centers like Hong Kong and Singapore, Gift City struggles to offer a lifestyle that keeps senior talent resident.
That's significant. With Gift City attracting global banks through tax incentives and simpler regulations, these departures highlight talent retention challenges, especially since many employees live outside the city due to limited local amenities. The talent war could impact Gift City's expansion plans. Strengthening local infrastructure and entertainment might be essential to support its nearly 28,000-strong workforce and sustain leadership continuity.
Now, let's discuss another important development. CARE Ratings assigned Indus Infra Trust a AAA issuer rating and reaffirmed AAA stable on long-term bank facilities totaling Rs 7,901.52 crores. The commercial paper program is rated A1+, underscoring strong creditworthiness. Notably, Rs 3,511.68 crores of the long-term facilities remain as proposed term loans yet to be drawn. Monitoring their utilization will be critical for maintaining the trust credit profile.
This AAA rating signals very low default risk, making Indus Infra Trust highly attractive to investors seeking stability. The reaffirmed ratings reflect consistent financial discipline amid a challenging market environment. Investors should watch capital structure updates and debt servicing closely, as successful execution of these facilities will sustain the trust's top-tier position in the debt market.
Moving to our next story. Central Bank of India aims to recover over Rs 3,500 crores from bad loans in financial year 2026 to 2027, up from Rs 2,300 crores to Rs 2,500 crore expected this year. Alongside recoveries, the bank plans to grow fee income by launching wealth management and credit card services by mid-year plus cash management products for corporates by August, diversifying revenue beyond interest income.
This recovery target signals stronger asset quality efforts, especially with their one-time settlement schemes and SARFAESI Act actions. It should improve profitability and reduce stressed assets in a challenging credit environment. Expanding non-interest income is key for banks now. Central banks' focus on these services and centralized foreign exchange sales can boost stable earnings, supporting long-term financial health.
Let's look at another key development. Supra Pacific Financial Services approved a private placement of 50,000 secured, unrated non-convertible debentures totaling Rs 5 crores with an annual coupon rate of 11.60%. The debentures are secured by current assets and unlisted, so investors get security but limited liquidity. Afcon's infrastructure raised Rs 25 crores through commercial papers with a fixed tenure of 6 months, maturing on December 3, 2026, carrying an interest rate of 8.05% per annum paid upfront. The issuance was privately placed with the Maharashtra State Cooperative Bank Limited, indicating targeted institutional participation, which adds to the stability of the funding.
That fixed rate is attractive, especially with monthly payouts over a 2-year tenure. It targets high net worth individuals due to the minimum subscription of 1 crore rupees. This move aligns with market trends where firms prefer secured debt to raise capital, balancing risk and return for select investors. Listing these papers on the National Stock Exchange improves liquidity and investor confidence, especially since they are unsecured but backed by a strong credit rating of CRISIL A1+. Compliance with SEBI's Regulation 30 ensures full transparency, aligning Afcon's debt instruments with market best practices and reinforcing trust among investors.
Let's look at another key development. Indian government bonds rallied as the government considers removing the 12.5% capital gains tax and the 20% withholding tax on interest for foreign investors. This could boost foreign inflows, especially with Bloomberg's June review for global index inclusion approaching. Marcellus Investment Managers launched a global equities fund via Gift City, targeting Indian retail investors. It opens for subscription from June 8th to June 19th, with a minimum investment of $5,000 and an annual expense ratio of 2%. PNB Housing Finance plans to raise up to Rs 5 billion through a 5-year bond issue at an annual coupon rate of 8.35%, while Rural Electrification Corporation targets between Rs 5 billion and Rs 30 billion, with bonds maturing in 2 years, 8 months and 18 days. Bajaj Housing Finance accepted bids totaling Rs 200 crores for its 7.83% coupon bonds maturing in May 2029, priced to yield 8.15%. Microfinance institutions may see a slight rise in non-performing assets in fiscal year 2027 as write-off policies return to normal, while Regency Fincorp is raising Rs 50 crores through secured non-convertible debentures with a coupon of 13% per annum and a tenure of 2 years and 6 months.
Lower taxes on foreign investment improve bond appeal, but inflation and rupee weakness still pressure the market. This fund offers Indian investors a way to diversify internationally without overseas remittance hassles and helps manage concentration risk by blending Indian and US equities, aiming for higher returns with lower volatility. PNB Housing's AAA rating reassures investors about credit quality and steady income, while REC's AAA rating also attracts fixed income investors seeking medium-term returns amid stable market conditions. Strong investor interest highlights confidence despite shorter tenures across issuances. The microfinance sector's correction after rapid growth post-pandemic should eventually improve long-term stability and discipline, while Regency FinCorp's combined debt and equity strategy enhances liquidity and supports growth. Investors should watch subscription levels, warrant collections, and how effectively funds are deployed to sustain the security cover and future profitability.